$14 million. The summer of 1929. Floyd Odlum's vault held $14 million in cash. While everyone else was buying, he was selling. October 1929 arrived. The market collapsed, and that $14 million became oxygen in a vacuum. This is not a retelling of the Great Depression's tragedy, not a condemnation, not a celebration. What we track is cash, how cash becomes the most violent asset when a system collapses. Violence here is not emotion, it is the power to set prices. We follow the transaction record, who lost, who took. We track the structure through which money moved. The late 1920s. America was selling dreams. The Dow climbed nearly 500% over 8 years, 1921 to 1929. Taxi drivers offered stock tips. Shoeshine boys quoted intraday prices. New investment products flooded the market. In 1929 alone, investment trusts issued $3 billion in securities. By August of that year, a new trust launched every single day. A brief clarification on investment trusts. Think of them like today's mutual funds, pooling investor money to buy stocks. But the 1929 version was different. A trust bought shares in another trust. That trust bought shares in yet another. A box inside a box inside a box. Borrowed money buying borrowed money. The most dramatic case? Goldman Sachs. December 1928. Goldman launched an investment trust, the Goldman Sachs Trading Corporation. It opened at $104 per share. By early October 1929, it had climbed to $326, triple in less than a year. It didn't stop there. July 1929. Goldman used that trust to create another, the Shenandoah Corporation. 25 days after Shenandoah went public, Shenandoah created yet another, Blue Ridge Corporation. Trust inside trust inside trust. On the way up, leverage amplified gains. On the way down, it amplified losses. Thursday, October 24th, 1929, New York Stock Exchange. The phones did not stop ringing. Panic had begun. Trading volume shattered all records. 13 million shares dumped in a single day. The ticker tape machine, transmitting price data, fell 2.5 hours behind. No one knew in real time how far prices were falling. Tuesday, October 29th. History calls it Black Tuesday. Another 16 million shares dumped. The Dow dropped 25% in 2 days, and the fall did not stop. The Dow stood at 381 in October 1929. By the bottom in 1932, 41 points, an 89% decline. It took 3 years. A vacuum formed. Like air being sucked out of a room, cash began to evaporate from the market. Margin rules were different then. Many investors put down just 10%, borrowing the other 90% to buy stocks. A $100 stock purchased for $10. A 10% drop wiped out everything they owned. Then came the margin call. Pay back what you borrowed. They had to sell. That selling pushed prices lower. Lower prices triggered more margin calls. One vacuum created a larger vacuum. What happened to the Goldman Sachs Trading Corporation? $326 in early October. By 1932, $1.75. A 99.5% collapse. Shenandoah, from $39 to $3.63. Blue Ridge, from $29 to $2.63. The same structure that stacked trust upon trust, when reversed, had no floor. The leverage that multiplied gains on the way up multiplied losses on the way down at exactly the same rate. Economic historian John Kenneth Galbraith described this period with precision. The autumn of 1929 may have been the first time in history, he wrote, that people succeeded in defrauding themselves on a massive scale. The collapse of the trust structure was the result of absent regulation. Of the $172.5 million in losses recorded by 14 major investment trusts, Goldman Sachs Trading Corporation accounted for 70%. The banks began to fall. In the first 10 months after October 1929, 744 banks closed. Between 1930 and 1933, 9,000 American banks shut their doors. 1/3 of the entire U.S. financial system gone. There was no deposit insurance. When a bank closed, deposits vanished in full. According to records from the Federal Reserve Bank of St. Louis, by April 1933, approximately $7 billion in deposits had been frozen or lost. That year, lines formed outside banks, starting at 4 in the morning. People came to withdraw their savings, waiting before the doors opened. But some days, the doors did not open. The bank had already closed the night before. No formal notice. A lifetime of savings, gone by the next morning. The air left the room, as if oxygen had been pulled away without warning. In the countryside, something different was happening. Consumer prices fell 25%. Wholesale prices dropped 32%. Farm prices fell first and faster. Farmers owed money to the banks, but the money they received for their crops had been cut in half. The debt stayed the same. The income was halved. The farm, their collateral, went to auction. Between 1930 and 1934, forced auctions swept the country. According to records from New York social workers, 25% of all students in New York were malnourished. In the mining regions of West Virginia and Kentucky, that figure reached 90%. At this point, an important question emerges. Where cash disappeared from? Where did it go? When the vacuum consumed everything, who was doing the consuming, and who was being consumed? October 1929. Floyd Odlum's vault held $14 million in cash. At that moment on Wall Street, apart from a handful of major banks, almost no one held that kind of liquidity. A newspaper account described him this way. After the crash, Odlum looked quietly around. On all of Wall Street, besides a few major banks, no one had reserves like his. Odlum started as a lawyer. In 1923, he pooled $39,600 with his wife and 2 friends to form an investment partnership. 6 years later, that sum had become $6 million. A cumulative return of more than 15,000%. In the summer of 1929, Odlum sensed something was wrong. He sold half his portfolio. He raised an additional $9 million through new share issuance. Then, he waited. The market collapsed. Investment trusts fell through their floors one by one. Odlum began to move. He acquired controlling stakes in near-bankrupt trusts at 60 cents on the dollar, sometimes 50 cents. The nickname followed, 50-cent Odlum. From 1930 to 1933, $14 million in cash became $150 million in controlled assets. The same assets, the same shares. Before Odlum bought and after, the numbers on the paper were identical, but the price was different. Crisis changed the price tag, and the one who could read that price tag received the title to the asset. This was Odlum's method. Buy the controlling stake in a near-bankrupt trust at a discount. Liquidate the assets that trust holds. Use that cash to buy the next trust. It compounded like a snowball. Starting in 1930, by 1935, $150 million in controlled assets. In today's value, approximately $2.2 billion. By 1933, Odlum had entered the list of the 10 wealthiest Americans. Greyhound Bus, Paramount Pictures, Hilton Hotels. All of it passed into Odlum's hands during the Great Depression. Inside the vacuum, cash moved exactly like this. There is another transaction record. Joseph Kennedy, father of the future American president. In 1929, he is famous for a story. A Shoeshine boy gave him stock tips. If Shoeshine boys are talking stocks, he concluded, the party is already over. Kennedy sold his shares. He also took short positions, betting that the market would fall. Monday, October 28th, the market dropped 13%. Tuesday, October 29th, another 12%. Kennedy made money while everyone else lost. 1933, months before Prohibition ended. Kennedy secured the exclusive U.S. import rights for premium British whiskey and gin brands, Haig & Haig Scotch, Gordon's Gin, Dewar's Scotch. He had been preparing for the moment alcohol became legal again. After Prohibition's repeal, his liquor business was sold a decade later for $8.2 million. In today's value, more than $100 million. Kennedy had secured cash before the crash, then used deflation, when purchasing power peaked, to acquire real estate and business licenses. By the time the crisis ended, the Kennedy family fortune stood in the hundreds of millions. The restructuring of the banking industry cannot be overlooked. The deposits and branches of the 9,000 failed banks did not disappear. They were absorbed by surviving major banks. Without deposit insurance, bank runs killed the small banks, and the customers of failed banks migrated to the ones that survived. Where competitors disappeared, the survivors naturally assumed the monopoly. There is also the record of farm auctions. The sellers, farmers who could not repay their loans. The buyers, wealthy landowners and life insurance companies with cash. Between 1930 and 1934, farms changed hands at a fraction of their market value. Deflation pulled farm prices down. The debt stayed fixed. The collateral was forcibly transferred. This was not a failure of individual judgment. The structure created the transaction. A question arises here. Were the winners geniuses who saw everything coming? Odlum's story has a reversal. When he sold in the summer of 1929, it was not a perfectly timed exit. According to official records, Odlum's own Atlas portfolio declined 21% after the crash. He took the hit too. The difference was that he had more cash than losses. Without that cash, Odlum would have been indistinguishable from any other trust investor. Kennedy's case is no different. Having navigated the Depression through short selling and cash, Kennedy was appointed the first chairman of the Securities and Exchange Commission in 1934. The man who had used Wall Street's most aggressive techniques now sat in the seat that regulated them. History produces this kind of irony with some regularity. The winners did not win because they were geniuses. The structure created the opportunity. The absence of deposit insurance caused the bank runs. The absence of leverage regulation for investment trusts accelerated their collapse. The absence of margin regulation forced cash-poor investors into liquidation. That structure created the vacuum for those who held cash. Vacuums do not form from nothing. The absence of regulation is what creates them. After the Depression passed, the world changed. The Banking Act of 1933, Deposit Insurance. The Securities and Exchange Commission, 1934. The Investment Company Act of 1940. Pyramid trusts outlawed. Crisis creates the rules. Those rules reshape the form of the next crisis. But one thing repeats: the moment of suffocation does not begin with fear. It begins with liquidity. Look at the numbers again. Between 1929 and 1933, U.S. real GDP contracted by 30%. Unemployment surged from 4% to 25%. Consumer prices fell 25%. Wholesale prices dropped 32%. Money supply declined by nearly 30%. As liquidity dried up, money itself became scarce. These numbers mean one thing. In deflation, the same dollar buys more. A dozen eggs, from 50 cents to 13 cents. But on the other side, the real value of debt grows. Prices fall, the principal stays. So cash is not safety. It becomes the gap. And the gap becomes the power to set prices. This is the structure of deflation. This is the violence of cash. There is an irony from 1929. In that era, holding cash looked foolish. Stocks were rising, trusts were climbing. Everyone was borrowing to invest. Cash looked like a missed opportunity. But that is precisely the moment liquidity begins to dry up. When everyone abandons cash for assets, if the system collapses, those without cash face forced liquidation. Those with cash set the price. Crisis changes the price tag. The moment the price tag changes, ownership transfers. It took Odlum 3 years to acquire 22 trusts. In those 3 years, what changed was not value. What changed was the owner. While Odlum was buying those 22 trusts, what was happening on the other side? Millions of ordinary investors were selling their trust shares. Bank depositors stood in line at the teller window. Farmers received auction notices. Without cash, you cannot survive that moment. You cannot breathe. What did the Federal Reserve do during this crisis? The central bank was supposed to protect the banking system. In practice, it moved in the opposite direction. In 1928 and 1929, the Federal Reserve raised interest rates. The intent was to stop speculation. The result was the opposite. Tightening triggered economic contraction. Economic contraction triggered bank failures. Bank failures triggered a decline in money supply. In 2002, Ben Bernanke, then a Federal Reserve Board governor, spoke at Milton Friedman's 90th birthday celebration. He acknowledged that the Federal Reserve's errors had contributed to the worst economic catastrophe in American history. And he made a promise. We did it. We are very sorry. We won't do it again. But keeping that promise also took time. The Great Depression left more than numbers. Marriage rates fell. Birth rates declined. Families left for distant cities looking for work. Children dropped out of school. In the early 1930s, 1 in 4 Americans had no job. And beyond that 1 in 4, millions more worked part-time, uncounted in the official figures. The market collapse did not only destroy numbers. Unemployment and poverty shook politics. Capital withdrawal broke Germany's economy. And in 1933, the political landscape changed. Japan, by contrast, abandoned the gold standard in 1931, expanded its money supply, and began recovering by 1933. Same shock, different institutions, different outcomes. Structure chooses the ending. 1929 to 1935. 6 years. One sentence to describe what happened. Those who held cash and those who borrowed it switched places. Those who borrowed to invest faced forced liquidation. Those who held cash received their assets at a discount. The market created this exchange and accelerated it. Not individual choice, The structure operating as designed. After the Depression, Greyhound bus kept running. Paramount kept making films. Hilton hotels stood where they always had. Before the crisis, the building existed. The route existed. The reel was rolling. After the crisis, one thing had changed: the owner. The moment the price tag flipped, ownership transferred. The Great Depression leaves a simple conclusion. No one came. No rescue. No safety net. No stop button. All that remained when everything stopped was cash. Cash in a crisis is not safety, it is power. In the moment of suffocation, someone had to sell. Someone else got to write the price tag. The question we must ask is one: when no one comes next time, what remains in our hands?